In this video, guys, we're going to look at static versus dynamic support and resistance. Which is better? Stay tuned. Hey guys, a very warm welcome to you. All right, thank you for joining me. Okay, so we have support and resistance can come in the form of either static or dynamic. Static being that it's a fixed level, it's a fixed price, it never moves. Dynamic meaning obviously that it moves as time goes by. So a static level could be 100 and that would be on the chart as a horizontal line. A dynamic would be something that's changing. It's not always 100, it could be 101, 102 the next hour or the next day or the next week. It's changing. And so what I want to look at in this video, guys, is what are the differences between the two and which is better under which conditions, because I've got an opinion really on, perhaps sometimes some are better than the others. Anyway, so let's have a look. So examples of our static support and resistance would be a key support and resistance number. So just like you would go on your chart and you would see a key level, you'd mark that down, then you'd go across and you'd see at the side of your chart on the axis what that number actually was. And you draw a few levels, they would be static levels. If they're under the market, generally they're support. Above the market, they're going to be resistance. Then we've got things like whole numbers. So we know that the markets, depending on what markets you trade, they gravitate towards whole numbers. Sometimes they stall at whole numbers. Even things like crude oil, for example, even things like crypto, your commodities, your indices, they like whole numbers and they sometimes get a bit sticky at whole numbers. So that might be a static level because obviously that's just a fixed number. And we've got things like the prior open, high, low, close. Perhaps not the open so much, but the prior, and prior I mean by yesterday's, or could be last week's, or it could be something that's happened a while ago and you've carried on drawing that. So that's a gap from a while ago, and that would be like a close, because a gap is always a close from open to a close. Or it could simply be the prior day's high, could be the weekly high, could be the 52-week high, 52-week low. You get the idea. So that's a static level that just follows on through, and it's based on a previous extreme or a previous closing point or open point. I don't necessarily always use opens, but perhaps you're day trading you will, because using the open as a reference point is very handy as a day trader. But generally speaking, once you've had a few days under your belt, you're not going to be looking at kind of six or 7 days back open, almost irrelevant. But you are going to be looking potentially at the highs or lows or closes if they're at extreme off those few days. All right, so those are some examples of static. Let's look at dynamic now. So dynamic, the obvious one is a trend line. So you've got a market that's trending up, maybe it's in a channel, maybe it's not, and you're drawing a trend line on your chart like this, and we'll look at a kind of little example in a moment. That is constantly changing the number, or the price. It's a dynamic resistor support level if you're in an uptrend compared to the static one. So as we go through time, then that's getting a little bit higher, a little bit higher, a little bit higher, a little bit higher. So it's not a definitive, definite price. Moving average, another one. Very often people use moving averages. So as the price comes up and comes back to a moving average, or it crosses it, or different ways of using moving averages. Done lots of videos like that on the channel. Go and check them out if you're into moving averages. But that again is changing with the flow of price, and it could be used as a tool to create, there's a support there, I'm going to buy off this moving average after the first touch, or I'm going to wait for this, I'm going to wait for that. Another thing could be a wedge or triangle. So of course similar to a trend line, but a wedge or triangle when we have that one downtrend, one uptrend if you like, containing price, coming to an apex, coming to the point, and then the price is breaking out. So as price is staying in it, we've got literally two things that are compressing it down, and both of those are dynamic. One's a dynamic resistance and one's a dynamic support. Keeping price in on a higher time frame, generally speaking, could be on a lower time frame, but generally it's a broader, higher time frame. You've got a price coming to a kind of point, and then it's either going to break out one way or the other. And again, go and check out some videos where we talk about rules and strategies to trade on that if that's piqued your interest. But back to this, static versus dynamic. So if you had a chart here, what will be static, what will be dynamic? So obviously, obvious ones, guys, if we're doing our key support and resistance levels, there will be a resistance level, there'll be our support. Those two are going to be static. We've got a moving average here, and that's obviously going to be dynamic, pushing up. And then maybe we've got a trend line here, which again would be dynamic. So we could use these under different circumstances. So what's the best under different conditions? So there's no doubt in my mind that a static is, generally speaking, static is better. There are some caveats, we'll talk about that in a moment, but generally speaking, because of this, there's no ambiguity around the level. You can have a little bit of ambiguity of the angle you draw your trend line, the thickness you draw it. Do you draw it on the peak? Do you draw it on the top of the candles? Do you draw it on the cluster of price? There's a little bit of ambiguity. Support resistance, yes, there is sometimes ambiguity. You know, if you've got a cluster of price, let's say here, you know, some people may well be saying, well, you've got to draw it on the peak. Some people may draw it here. And so, yes, there's slight ambiguity, but not enough to change people's perception of what happens when price comes back up to somewhere around there. You know, they are doing something at that level. Yes, there might be slight discrepancies, but not big enough, whereas a trend line can be just a slight angle difference, can make a massive difference as you start to extend and extrapolate that out. So just from a point of that everyone's looking, also things like, you know, the prior day's open, high, low, close, that's just a definite number. It's an actual number. There's no guessing with it. It is what it is. That was the close, that was the high. Everybody is aware of that. So because of that, and because there's no fudging it and different ways of interpreting it, means that more people are looking at it and more people are going to be making decisions based on price response to it. So buyers may well be more encouraged if we break through it. Shorts may well be fearful if we bounce off it. And so if you think of all the market participants, they may well have orders that are revolving around that, whether they are stop orders, whether they are sell orders, whether they are buy orders, whatever they may be, then that becomes a focus point that everyone is looking at in the market. If you've got something that's more dynamic, then not everyone's going to be looking at it necessarily. Maybe not everyone's even going to draw in trend lines. Everyone knows what the prior day's high was of the market they're trading. Not everyone has got the same trend line on, so it might not be as useful. Same with moving average. Depends what moving average you have, right? You've got a 20 period, you've got a 15 period, 5, 80, all going to get different things. So generally speaking, static is the better one because of the majority of people can see the static, especially when you're talking about open, high, low, close. However, dynamic works as a guide. So rather than saying, okay, it's a level that everyone knows about, everyone's kind of aware of this high or the low, whatever it is, the trend line or moving average is something that you've interpreted on price, or the moving average is a calculation on price, obviously, but it's a useful guide to say, hey, this could provide a turning point. Now, yes, everyone's not going to be looking at it, but it's useful for you to frame your trade that if you already want to be aligned with, let's say, long, price then pulls back, you're trying to find a good entry point to buy at, then a dynamic support level from the moving average coming up might well be what's needed. It might well be just enough you'd say it's poked through that, it's close back up, there it is, there's my point. It's a reference point, it's a nice framework to put your trade on. Similarly, if you've got your trend line, you know, price has pushed well off, you're like, well, I'll wait till it comes back to that trend line I've drawn or within the vicinity of that trend line before I look to initiate along. So whilst it might not be as strong and as broadly aware as some of the static ones, so more people are aware of these ones, it's still useful under certain circumstances, like guiding you in an uptrend when to get long, guiding you in a downtrend when to get short, making sure you're not chasing because it's too far away from the trend line. Okay, I'm going to wait for it to pull back a little bit, wait for that moving average to catch up, wait for it to consolidate a bit, then that dynamic support will catch up with it, then that might give it a little bit of a reason for me to go long. So under those conditions, works very, very nicely, comparing it to the others when you're like, okay, well, actually I can structure, I know that there's going to be people doing business around that level. I don't know specifically if people would be doing business around that moving average, but from a price action perspective, it might just be enough time for the price to have unwound and relaxed a bit, and I'm using that as a guide to maybe give it a shove to the upside. So two ways of looking at it, guys. You've got static and dynamic, similar, obviously, but under certain conditions, know when to use which, and know the downfalls as well, and understanding, again, you know, we talk about this lows, guys, of gaming theory of well, who's on the other side of that trade, who's looking at the same thing you are, if they are, what are they thinking, and that kind of thing. And also being aware of the downfalls and the pitfalls, and saying, well, actually no one's probably looking, not many people are looking at moving average, so it's just me and my perception of how price is behaving. That's the use of it, that, rather than saying, oh, everyone's trapped because we've gone under a moving average. No, whereas could be everyone who's trapped, if everyone's trapped if you've gone under a key support level. Difference in the way of thinking. All right, guys, take care and I'll see you in the next one. Keep your risk managed. Bye-bye.